Hi everyone and welcome to Financial Basics. Today I'm going to be doing something a little bit different to what I normally do with the presentations. I'm actually going to be going through step by step the final process before you actually make an investment. I'm going to be doing it with a practice account, so I won't be using real money. But I am just going to go through that process of comparing a broker, selecting a broker, comparing an index fund and selecting an index fund, actually looking at what that index fund includes. And for the UK specifically, I'm also going to just be taking a look at what protection is in place for that particular broker. And then we're actually going to go through the process with the practice money of buying our first investment. And the idea here is just to demonstrate how simple and how easy this process actually is, because a lot of people are really afraid of these final steps, particularly when dealing with real money. So step one is fundamentally just choosing what platform you actually want to invest through. So Motivator has a great comparison table where they're looking at pretty much all of the platforms in the UK and how they charge you, whether they charge you on an annual basis, what trading fees might be included, whether they're charging a percentage of the value of your portfolio. It's all in there. It's a really good table just to start making that comparison and just looking at what the differences are and how they charge. So for me, we can just go straight there. I'm looking at Trading 212. Trading 212 is being listed here. They don't have any fees in the traditional sense. They do have a 0.15% foreign exchange fee, but there's nothing else listed. So what this table is not showing you is that the way Trading 212 is going to make their money is they're going to be basically skimming off the margin, so to speak. And what I mean by that is there is a spot price, the price that you see when buying something or selling something, or a particular exchange rate, and the price that you get. So if you were to, for example, go to your bank and try and exchange into pounds into dollars, you would see one price. But if you compared that to the actual spot price, if you just looked at the current exchange rate, you're going to see a difference there. And what Trading 212 is basically doing is they're making money on that difference, whether it's buying or selling. So the reason why I'm selecting Trading 212 is because they offer a free practice account that allows you to actually go through this process. Once you've selected your broker, you would be looking at which actual fund to invest in. Motivator also has a great table for this, comparing just all of the different options for different types of index funds or low-cost index funds, and then they just rank them as like either the cheapest or the best, or for different categories. So if you want to invest in world equity, or if you want to invest in the developed world only, or if you want to invest in UK, whatever it is, they will have an option in here that you can look at. And again, I need to emphasize, whether you're selecting a broker or whether you are selecting a specific index fund, the key thing here is to make sure that you speak to a financial advisor and have a very good understanding on some level of your risk profile. And a financial advisor can do that for you to some extent. So just be aware fully of things like how close you are to retirement, how risk adverse you are, what sort of return you want to get. All of these things and many other factors play a part in deciding what you actually want to invest in. For the FIRE community, they just want to invest in a global index fund, a cumulative global index fund, where that money is being reinvested, and they want to be as want to buy the entire market, so they want to be as distributed as possible in their purchase. So if we go into Trading 212, I've already set up an account. I can just log in here. And once I'm going to skip the verification process, they will need to verify your identity before you can actually add funds to the account. But once you're in, this is what it looks like. You can see there's various shares down the side there, probably popularly traded shares from what I can tell. And what those shares have done for the last year or whatever period you want to look at. If you want to go into a trading account, you can just click at the top, switch to practice. And they're going to give you two options here. So they're going to give you just normal investing, or they're going to give you CFD. So CFD is basically where you're trading using a leveraged position. So you can either go long on something or short it. So you're making a guess on what the price of that is going to do in the future. Under normal circumstances, if you look over here, you can also see that they also have something called a stocks ISA. This is the tax-free version for the UK, where you can invest up to £20,000 per year into an account, and it's the same the same investments, right? So that you can invest in the same shares or same low-cost index funds in a stocks ISA as what you can in your normal investment account. So we want to switch to practice. We want to do normal invest. And you can see they've given you £5,000 to start that process. So you can obviously start trading or practice trading. So what I want to do at this point is I just want to look at the index funds. So if I just search VWRP. So this is a Vanguard All World Global Index Fund, and it is accumulation. So you can see it there. And if you just scroll down, you can see instrument details. And if you scroll down on that, you can look at the key information document. And yeah, it's going to tell you a little bit about the fund. It's going to tell you the risk profile. So the reason why it rates this as a high risk is because it's all index, it's all shares and stocks, right? So what that basically means is you're not invested in bonds, you're not invested in anything related to property or sort of the low cost, like the other side of it, where potentially you're going to get that money coming back to you. It's not loaning the money to government where you get a 4 or 5 or whatever percentage return on those bonds on an ongoing basis. It's very unlikely that the governments are going to fail. And you can see, if you scroll down a bit, you can see the ongoing charges here as 0.22%. So that is quite low. Obviously, you want to just make those comparisons between various funds. But the key thing here is this is a passively managed index fund. And what that means is there's no active management. It's just following what the index does, right? It's trying to mimic the index as best as possible. What this isn't showing you is what that index actually consists of. So we can just take a look at that here. This is the All World VWRP All World Accumulating Index Fund. So there's your fee. It shows you how many different companies are included in this index fund. And if you scroll down a bit, here you can see the number of stocks, you can see the market capital or the median market capital, the PE ratio. And here's the interesting thing, at least from my perspective, if you're trying to get a better understanding of what the fund actually consists of. So this basically shows you the different countries as well as the regions, what portion of the fund is invested in those different regions or different countries. So this one, even though it's a global fund, it is still heavily invested in the US. And the reason for that is because US companies play a huge part in the global market. And therefore that is reflected. You can see the weighted exposure here for the different sectors. You can also look at the table. So from a sector perspective, a lot of this is technology and the finance. You can see industrials are in there, healthcare is in there, energy is in there, real estate is in there, all of these different things. So these are companies that trade in those different sectors. And then if you scroll down a little bit more, you can actually see exactly which companies are inside of this fund or in this low cost index fund. And you can see what percentage of it makes up the overall fund. So Apple, for example, here makes up 4.48% of the value of this fund. And the reason for that is just because it has a really large market cap. So it's one of the biggest, it is the biggest company in the world, at least by market value. Nvidia's 3.93%, Microsoft 3.92%. But what I want to show is you can actually download this. And if we just go to that one. So if we just look at this here, so you can see what sector they're in, their market value, how many shares, and the percentage. And you can see very quickly the percentage drops off. So if you scroll down a bit, already even just a little bit down on this list, you're talking about Coca-Cola taking up 0.29% of the portfolio. And if you go down a little bit more, you can get to 0.03%. Already at the 500 mark, you're talking about 0.03%. So 0.03 of a percent of your portfolio will be in Kraft Heinz or Edison International or Canon. So you're talking about, even though it appears concentrated, looking specifically at the top of this table with the 4%, once you start getting into the meat of it, it takes a lot of these companies to even make 1% of the value of the overall fund. So if we're happy with that, and we've taken a look at the various funds, we've taken a look at the low cost index funds, and we've made that comparison, and we're happy with the risks, we're happy with the profile, then absolutely you can decide, I want to buy this. And again, speak to a financial advisor if you are unsure or if you have any questions. Always suggest when making investment decisions to speak to a financial advisor. It is absolutely a key part of the process, and it just gives you that confidence to potentially stay in, or when everybody's jumping out, or if the price drops by 5%, so you don't go into a panic mode. They're there to be your partner in walking through the process. And I always recommend advisors that will not take a percentage. You want an advisor that is actually there for a flat fee. So you don't want an advisor that's obviously that comes in and says, give me 1% of your portfolio every year. You want somebody that's coming in and saying, we are going to charge you X amount, and we're going to look at your profile and we're going to make suggestions based off of that. So just going back to trading 2 and 2, let's see if we can actually buy this. I confirm. Oh, no, wait, where am I? Am I in the trading? There's this one. There we go. So I can just buy this. And how much do I want to buy? Let's say everything, because why not? We've taken a look at it. We're happy with it. We don't need to make this more complicated. We don't need to get nervous about making these investments. So I can just review order. I'm buying 43 of these, 5,000, send the buy order place. It'll execute after the market opens. Okay, and I'm done. I have my investments, and it'll go off once the market reopens. And that's it. That is how simple it is to actually invest and start that investment process. The only other thing that I would note to check, at least in the UK, is you also want to make sure, and I've got it up here, that Trading 212 is, or any broker that you use, is part of the FSCS. It's the Financial Services Compensation Scheme, where you get protection up to 85,000 in the event that the bank actually fails or the entity itself fails, because those underlying assets still exist and you need your protection from that perspective. Thank you very much for listening to me. I hope it was useful. Please feel free to like this video or comment on any questions that you have, and share it with anybody that you find useful. Please also subscribe to my channel. It really helps me out. Thank you for listening, and see you next time. Goodbye.